Testing 1, 2, 3. Did I hear that? Okay. Sorry, I had my microphone inadvertently muted. So we're going to go back and start over with actual voice. Um, so when we started our company, we started as a derivatives research firm back in 1990, and we mostly published newsletters and sold data at the time. We had a very successful number of recommendations in the 2008 financial crisis. So some clients asked us to move into money management, which we did shortly after that. And we manage money both as a CTA in the futures area and RAA in spiders and SPX. We also do a certain amount of option education, which is mentoring and things like this webinar today. So this year our accounts are plus on the year. The accounts we're managing, we're using many of the same strategies that we used back in 2008. Mostly volatility-based things are working quite well. Our newsletters are doing well again, as they did back then, on a number of fronts, both in put-call ratio type situations as well as in volatility trading situations. We're offering 30% off on our two main newsletters, Daily Volume Alerts and the Daily Strategist. And to access that page with those discounts, you just go to optionstrategist.com/MAR20. It shouldn't ask you for a coupon code, but if it does, MAR20 is the code. We'll talk more about those things later on. So as far as the market goes, we look at four main things: the chart of the S&P 500, equity-only put-call ratios, market breadth, and volatility indices, primarily VIX. So let's get started here. Before we do, though, I want to point out there's a very important rule, and it's certainly apropos right now, and that's oversold does not mean buy. Oversold markets can continue to decline for quite some time, as this one is doing. We probably got oversold, I'd say, late February. That first week we broke down, February 24th to 28th. By the end of that week, we certainly had some oversold conditions, but they've just gotten worse, and they've really got much worse even today. Overbought does not mean sell either. That doesn't apply right now. Nothing is overbought here. So we're really concerned more with the first one. So here's the chart of the S&P 500. I'm going to erase the stuff that's on there. And today, this has got today's action on it, traded down to, well, actually 2380. So we traded down a little bit farther than that. And, you know, right now in the aftermarket is trying to hold that line. The lows of December 2018, which was a very ugly bottom, V bottom, we're now approaching those, and traders are hoping that's going to be support. There really hasn't been much other support levels. We crashed right through them without really blinking. I mean, there was one there, just didn't hold the line at all. There was even one up here earlier, again, didn't hold the line. So those blue circles there are gaps on the chart. And typically gaps do get filled. There was actually one right here the other day that got filled. But, you know, those are fading into the sunset from where we are now. So I don't think that top gap is going to be filled anytime soon, this one all the way up here. There's still a chance these two could get filled on a strong oversold rally. Typical oversold rallies will carry up to the 20-day moving average, which is this line right here, and is crossing under the 200-day, which is not good. That's, I don't know what kind of cross you want to call it, but it's not a good one. So those are situations that are, you know, we can rally back, but this 20-day moving average is falling quickly now. So by the time we get to it, stabilize, it could be, say, way all the way down there or something like that. And typically just getting back to that is just another reason to resume the decline. But if we are going to have like a bottom, a rally, and then a retest, that rally in the middle does typically come up to the 20-day moving average. First, we've got to even see if we can find a bottom somewhere. So this chart is very negative. I mean, there's just nothing about it that's positive right now. You'd want to see some sort of series of higher high, higher low, something. Maybe even just a little one like you had over here, just to give an indication that you can go up for more than one day, but that's all we've done so far. So this chart's very negative. Support levels have really not meant much. I mean, those were all supposedly support levels. I crossed them out. So now we're down to 2350, which basically means we've wiped out the entire gain from December of 18, which is a strong gain. All through the year of 2019 and the beginning of 2020, we've wiped that out in 3 weeks. So that's just depressing, really, even if you're short. So as a resistance, I mean, those gap areas might represent resistance. And technically, there's resistance on a classical sense at 2710 to 2740, which was like Friday's highs. But reality is that support and resistance are not particularly big players on the chart at this point in time. You'll be better served by looking at some of the other oversold conditions that might turn into buy signals. So the trend lines on this chart are obviously negative, with everything moving averages and declining, and also the Bollinger Bands that I'll show you in a minute. So this is overall a bearish chart, and really, I mean, this thing could rally all the way back to 3100 and still be a negative chart, because it would be below all the kind of things we're talking about. I don't think you're going to get a rally of that size, but even if you did, the chart would still have bearish implications. Now, Bollinger Bands is another thing that we look at, and when John Bollinger invented Bollinger Bands, he needed to define volatility. So he defined it as the standard deviation of daily closing prices, which seems like a pretty good way to define volatility, but it turns out that Black-Scholes, which is what the BS here is, Black-Scholes, those are the option modeling guys, and other mathematicians use a slightly different definition, and it's the standard deviation of daily percentage price changes. So that is a slightly different number, and since we're in the option business, our data needs to agree with Black-Scholes. Otherwise, things like implied volatility and what have you would not line up. So we recalculated Bollinger Bands using that definition of volatility, so we call them modified Bollinger Bands. And we draw a 3 and a 4 standard deviation band, and when the market moves outside of that 4 sigma band and then back inside the 3 sigma band, that's a signal. So we've had some pretty nice gains over the years, and if you get a copy of the Option Strategist newsletter, we summarize the trading results by system. There's an annual issue that goes into it in depth, but each issue has a summary of the profits made or losses from a system. So it recently issued a buy signal, actually 2 of them, but they're both stopped out. I'll get to that in a minute. So here, and this is a chart before we got all crazy here. Well, I don't know, it's actually does include it. So what this is a 4 sigma band right here, and this is the 3 sigma band there. So for example, we moved outside the 4 sigma band there and back inside the 3. That gave us a sell. That sell was a little premature, but then the market did decline. So red letters on this chart are successful signals, blue letters are not. You can see that last fall in November and then again in early December, we had a series, it was late December, a series of failed sell signals, but we did eventually have this one here probed up and then fell back in, and it looked like the market was going to break. And as you'll see, we're going to see we had several other very reliable intermediate term indicators giving sell signals in mid-January, but the market fell a little bit, but then went on to new highs. And this move to new highs in mid-February was a real sucker move. It pulled a lot of people in, made people doubt their systems. I mean, we have a system here that did not get stopped out, so we stayed with it. But believe me, it didn't seem like it was going to work. But then we got that big gap, and we're off to the downside. Now, the system takes its profits when it closes below the -4 sigma band, which it did right in there. And then because this made this sharp move up here, it actually gave a buy signal. So I'm going to go to the next chart. You can see it a little better. So there's the sell signal, just like zoomed in. There's a sell signal we were talking about in mid-January. The market did move higher, but then came down here. We closed below the 4 sigma band and then inside the 3 sigma. So that was a buy signal. That got stopped out when we closed back below the 4 sigma. Then last Friday, Thursday we had moved below, and then Friday above, again, a buy signal. That was stopped out today since we closed below 24.92. So now we're awaiting another buy signal. So obviously we're not going all in on these things. We're just buying a couple of spreads or something like that. Our main focus is still being short the market, but we do trade these counter trend signals. Typically they do a little better than this, but this is a wild market, and eventually one of these buy signals will be a very nice one. But right now we don't have one here. So what do we trade when we trade these things? Well, typically we trade a slightly in the money option, and the reason is that we're trying to make the option behave somewhat like the underlying. So in normal times, we can just buy an option. The delta of an option tells you how fast the option is going to move with respect to the stock price. So the delta of a call option resides between 0 and 1. 1 means it behaves just like stock. So the higher the delta, the more the option behaves like the underlying, and that's great. But if we're trying to predict what the underlying is doing, which in this case would be the S&P 500 or Spider, then we want an option that behaves like that. If we buy something too far out of the money with a very low delta, then that's a very speculative purchase, and we don't typically do that. So we normally in these situations look to buy an option with a delta of about 0.7 or higher, which for SPY means we're about 1 strike in the money. And that's usually what we buy for these things. Now, right now, volatility is so high that we're doing spreads, but I'll get to that shortly. So that's where we are in the S&P 500. A very negative chart, a couple of attempts to generate a modified Bollinger Band buy signal, but they both failed. So let's look at the equity-only put-call ratios. This means equity-only means we look at all stock options that trade. We calculate the put-call ratios using it as a predictor of the S&P 500 index. Marty Zweig invented put-call ratios back in the 50s, and it's a contrary theory. He was getting the data at that time out of the newspaper ads in Barron's, but he didn't. In those days, it was very, very low volume, but he did realize that it was a contrary indicator. So if too many people are buying puts, if the put call ratio is very low, then we want to do something bullish. On the other hand, if the too many people are buying calls, they're going to be wrong, and we want to do something bearish. So we'll quantify what too much means here shortly. But first, let's just look at the ratio. Suppose we're looking at IBM. At the end of the day, we sum up the volume on all the calls that are traded in IBM. Separately, we sum up the volume of the puts, divide the two puts divided by calls, put-call ratio. And so, and then we plot that. So Marty had puts in the numerator of this fraction, and they've remained there generally to this day. Some people actually do a call-put ratio, but most people do put-call. So if since puts are in the numerator of the fraction, heavy put buying is going to make the ratio go up. But when do you have heavy put buying? Well, typically when the stock is going down. So the stock is going down, the ratio is going up when there's heavy put buying. What about when there's heavy call buying? Calls are in the denominator of the fraction, so heavy call buying will make the ratio go down as the denominator increases. Meanwhile, when do you get heavy call buying? Well, you typically get that when the stock is going up. So again, they move opposite to each other. We keep a moving average 21 days just in case there's something to Fibonacci. And ideally, this is what you would see when you look at a put-call ratio chart. Now, we publish over 650 put-call ratio charts on our website every day under the strategy zone, which is a paid subscriber section of our website. The theory is this: let's say the stock is declining. As the stock is going down, people are buying puts, brings us all the way up here. Eventually, the put buying peaks out, and you get a local maximum on the put-call ratio chart. That's a buy signal for the stock. And then the stock starts to head up, and the put-call ratio heads down as people are buying calls. Eventually, you get all the way down here where call buyers are exhausted, and the put-call ratio makes a local minimum, and that's a signal to sell the stock. So that's the theory. This is not a current chart, but it is the S&P 500 on top, and the equity-only put-call ratio on the bottom. And notice the inverse symmetry. That's why we use the equity-only put-call ratio to predict where the market's going. So here's the current chart. And you can see that there was a very strong local minimum here in January. Remember, local minimum is a sell signal. Now, that occurred in mid-January. And again, just like that modified Bollinger Band signal, it was premature. The market edged its way higher. But all this did was go sideways and then eventually took off like that. So now we're racing to the upside. This does not have today's numbers in it, but does have all through Friday. And this was the bottom in 2018, and you can see we're almost back to that same level again. 85 here, by the way, means that 85 puts are trading for every 100 calls. In stock options, that's a lot. In between, you can see we had, local minimums or sell signals, local maximums or buy signals. They're good. They're pretty good signals, most of these. So along the way, we had some interim ones, but now we've had this really, really extreme one down here when there were typically only 55 puts traded for every 100 calls. And now we're racing to the upside, getting oversold, but we won't have a buy signal until it rolls over and starts to head back down again. And who knows where that's going to be. Since it's a 21-day moving average, it's probably not going to happen immediately. Then as computers came along, we could calculate a weighted put-call ratio. And this is a different ratio. Now we're measuring the dollars being spent on bearish opinion, not just the volume of bearish opinion. So at the end of the day, we take an options price and multiply it times its volume to come up with the dollar volume. Now, you could do that every trade all day long. That's a lot of computer power and a lot of expensive data. And we tried it for a while and realized that wasn't giving us any better results than using closing prices. So we just use the closing. So we make that calculation for every option. And again, let's say it's IBM. So we sum up those calculations for all the puts. Separately, we sum them up for all the calls, divide the two, and that's our weighted or dollar weighted put call ratio. And we're measuring the dollars spent on bearish opinion versus dollars spent on bullish opinion. Typically, you still get the same timing, but you get more extreme signals, which are obviously, should raise your awareness more. So you can see here, we got this same local minimum, a sell signal in mid-January, and now this is racing to the upside. But look where we were back in 2018. At that bottom, we had gotten all the way up to 180. 180 means $180 are being spent on puts for every $100 being spent on calls. That's across all stock options. That's a pretty crazy high number. And, this is a crazier market than ever. So I would say we probably have to exceed that number before we really find a buy signal from this weighted put call ratio. So just to recap, these ratios give us pretty good signals. They were very overbought and at multi-year lows in January. They rolled over to sell signals at that time, and they're still on those sell signals. Now, there's another ratio that we look at occasionally, and this is the total put call ratio. So this is all stock and index options, not futures options, but stock and index options. We calculate the put call ratio in the usual way, and it gets oversold. And I say officially because we have a set of trading rules around this system. It gets officially oversold when it rises, when the 21-day moving average rises above 0.9. Well, it's well above that now, but it's still rising. It won't give a buy signal until it rolls over and forms a peak. So sometimes it can take up to a couple of weeks to generate a buy signal, but when we get them, they're usually very strong. we've only had 30 trades since 2003, so not even 2 per year. Of the 30 trades, 24 were winners, 9 were losers. And we usually look for a 100-point rise in S&P. Now, these days, that's not so much. I guess we probably look for more than that this time. But of the 24 wins, 21 of them did produce the 100-point rise. And as I said, we have a trading system built around it. So in our newsletters, we talk about it specifically. On average, it makes 61 S&P points, again, in a much less volatile period than now. There's one other put-call ratio I want to mention. This one rarely comes up, but the equity-only put-call ratio calculated by the CBOE, and it rarely rises above 1. However, it's been above 1, I said last week on 4 days, and it certainly was again today. So it was 5 of the last 6 days, trading days. It's been above 1. That is a very, very oversold condition. And we did design a trading system around this, which was to buy the second day in any sequence. That occurred last week. So technically, we're long a couple of calls based on this. They're way out of the money now. But, this had a long history of multiple one readings. And then after 2011, in the big bull market has taken place since then, it rarely fell below 1 and never like 2 times in a row. Now we've had 5 out of 6. So it just really illustrates again how oversold the market is, but still obviously not a buy. So how do we trade these put-call ratio signals? Well, normally when volatility is normal, we buy an at-the-money option with a delta of about 55, and we go out a month or 2, sometimes even 3 with stock options. And so we're balancing the risk of the cost of an at-the-money option versus an in-the-money option to buy more time. But we still have a delta that's greater than a half. So if the stock starts to move up, we'll participate. It's not like we're buying something way out of the money. Now, what about spreads? Well, on TV, if you watch the option guys, and really not seeing too much of them right now, but they always spread. And I don't know why, because it's usually not a smart thing to do unless volatility is very high. That's the only time it makes sense to spread if the options are overpriced. So in a bear market, you can often do put bear spreads. In this particular bear market, any spread you did was suboptimal because it fell so fast. So the way to counter that is to widen the strikes between your spreads. You still get some benefit out of the spread, but in general, spreads were not good on the way up because markets went up faster, and now on the way down, they're going down even faster. So I'm not a fan of vertical spreads, and right now, let's say you got buy signals and the market started to go higher, VIX would drop. And so your long calls are kind of be swimming upstream on you. And so having a short call there somewhere is somewhat useful, but you don't want it to be so close that it runs right through your short strike. So it's a kind of a deft balance you have to achieve there. And really, so far in this move, trading without spreads would have been much better. I'm just going to show you a couple of put-call ratio charts. These are stocks that we are able to get in pretty nicely. You can see here Disney. So in stock options, by the way, we only take the signals that are at the extremes, like that one or this one. We don't take, like, here's a local maximum, but that's kind of in the middle of the chart. We want this signal to be occurring at below the 10th percentile of all previous put-call ratio readings in the last 600 days, or above the 90th percentile for buy signals. So again, we wouldn't call that a buy, we wouldn't call that a sell, we wouldn't call that a buy. But down here, we did get a sell in early December, and the market, came down a little bit, but not too much. And then maybe you could consider that a little buy, but then another sell came, and this is the one it broke. When it broke that support level right there that I've noted, then we got short. At first, it struggled back, but now this has been an excellent long put position, and the put call ratio is now racing to the upside here. But until it rolls over, we you won't have a buy signal. What we do in situations like this where we have profits build up strongly, we roll down to a lower strike, or if it's a call, we roll up to a higher strike, taking a credit out of the position and keeping it open. Here's JP Morgan again, sell signal at very low levels down here in January. Even though there have been a couple of failed sell signals before, when the put-call ratio gets down to essentially the 0th percentile, in this case like 50, we feel it's worth taking. So we did take that one, and it's worked out well. And just one more, Microsoft. This was crazy. This got down here in February to 20, meaning only 20 dollars are being spent on puts for every $100 being spent on calls. So even though these other sell signals, which had occurred at the requisite low percentile readings, were not successful, we did go ahead and take that one because the put-call ratio was just so low. And again, it's worked out well. All right, so enough for put-call ratios. Suffice it to say that we're watching these carefully, but they are 21-day moving averages in general, and they don't roll over all that easily. So they're not going to pick the bottom tick. But I don't think anything that we use is going to pick the bottom tick. I would much rather have a confirmed buy signal and have a market coming out of an oversold condition rather than trying to jump in and catch a falling knife somewhere during an oversold condition. But let's move on to market breadth. Market breadth is very simply advances minus declines. You can keep a cumulative total, which I'll mention in a minute, and or you can keep an oscillator, which we do. So we look at advanced declines in two different data sets. First is the traditional New York Stock Exchange data, but that includes some things that are not stocks. So since we have a nice universe of optionable stocks, we look at those too. So we call that our stocks only data. That's based on all optionable stocks. So here's the breadth oscillator going back to 2013 here. And by our definition, it's oversold if it gets below minus 400, and it's overbought if it gets above plus 400. And so in this particular case, you can see that we haven't been oversold too many times. This was December of 2018 right there. And that had been the record low, but now we've just exceeded that on Friday, and I'm sure we will exceed it by even more today. So this oscillator is the most oversold it's ever been. But just as here in January of 2019, we didn't buy till here, till it stopped being oversold. So it's going to take a while. You're going to need, 4 or 5 days of positive breadth, some of them really strongly positive breadth, to make this thing come all the way back and get up there. But it will eventually. It's just that we're not going to anticipate, even though it's at its most oversold reading in history. Sort of interesting to note here in December, after that December of 2018 reading, in January of 2019, it got extremely overbought. And again, remember, I said overbought does not mean sell. So all this time it's overbought. The market's roaring to the upside here. Finally, there was a little correction right in there, and we sold, but it wasn't that great of a sale. So right now, again, very, very oversold, but not a buy signal. Just repeating there. The one thing that was interesting to know, and in retrospect, it did mean something, I guess. Breadth never really expanded. When we moved from those all-time highs in January and February, the breadth oscillator, I'm going to go back here, it really wasn't all that overbought. You would have thought that's in this this area, even in here. You would have thought the same would have breaking out to new all-time highs. You might have at least had that happen, or this happen, or something. Barely got into overbought territory. So breadth was never all that great, and it was sort of a leading indicator. But more of a leading indicator was the cumulative advanced decline line, and we keep track of this. I have a different slant on this than many people, but you just every day you add the advances minus the declines, you keep the line going. If the market's making a new high and the cumulative advanced decline line is not making a new high, then you have a negative divergence. So cumulative advanced decline line stopped making new highs, and this is in stocks only data, are optional stocks. It stopped making a new high after January 16th, and as you know, the market went on and made new highs all the way through, I believe, February 17th or something like that, maybe even later. And so that was a negative divergence. A lot of guys will try to put a positive convergence on this and say if the cumulative advanced decline line is making a new high, then everything is fine, and along with the market. And it did so in New York Stock Exchange terms. And I'm actually going to let me look over here. I'll give you the exact date when that occurred. So on February 20th, so that was the high for the market. On February 20th, the markets made a new all-time high, and the New York Stock Exchange cumulative advanced decline line also made a new all-time high. Well, you see what's happened since. So that is completely false. That a confirmation by the advanced decline line on the upside means anything. It's only good as a negative divergence. Anyway, on to VIX. And this is where a lot of interesting things are happening in the market right now. And this is really where we've made the bulk of our money. First of all, the trend of VIX is very important. It should be trending opposite to the market. And this trend indicator gave a sell signal on February 20th, the day right after the market peak, or maybe the day of the market peak. Excellent sell signal in that regard. I'll show it to you in a minute. Also, though, spike peaks by VIX are buy signals in general, and we trade both of these systems. So this first one, this is more of an intermediate time type of thing. The spike peak is a particular system that we developed around the spike peaks. It's a short-term trade, about a month or so. Usually you're in it or you can get stopped out quickly. So a VIX that is turning higher is bearish for stocks, obviously, and without necessarily stating it, a VIX that's just bumping along at low levels is actually bullish for stocks. It's not a problem. VIX at low levels is not a problem until it starts to rise. It's that rising that brings things into perspective. So here's the current VIX chart, and we hadn't been above. Well, I think in December of 2018, we got to 36, which is pretty pathetic considering the extent of that decline. We haven't been up here anywhere like this since the crash since the financial crisis. In the crash of 87, it did get higher. It didn't actually exist then, but the CBOE backdated things and said that VIX would have gone to 150 during the crash, and it would have stayed above 100 for 6 days. So we're still hunting that one. I don't know if we'll get there or not. Anyway, when VIX spikes up like this and then back down again, it's a buy signal for the market. And you can see right here, there's actually two spikes in a row. We only take the first signal. Again, here, so the blue signals are negatives. The red signals are positive. And you can see we had a spike peak right there early in this move, like February 27th. It gets stopped out when VIX exceeds that peak, so that one stopped out there. Then we had another spike peak a week or so ago. That one got stopped out. And now we're all the way up here. I guess we got another one on Friday, and then that got stopped out today. So these are, again, we traded these like with small positions, just looking to perhaps catch the move going the other way. This is one that's going to come as close to picking the bottom as any because it's so responsive, but so far it hasn't. But I was talking about the sell signal, the intermediate term sell signal. That occurred down here. So this average right there is the 200-day, and this average right here is the 20-day. And we have a rule of thumb that when the 20-day crosses over the 200-day, which happened right there, and VIX is also above the 200-day, which happened right there, that's an intermediate term sell signal for the market. That's what happened on February 20th. The next day, VIX gapped higher, took off, and we had, so we still have this sell signal in place. But once this sell signal is in place and the term structure inverts, as I'm going to show you in a minute, some very interesting trades then set up. So right now we've had some repeated buy signals from the spike peak. If you're going to attempt this, we are trying with some small positions, but the intermediate term trend of VIX is still higher, and that's really what makes bearish a bearish chart out of volatility is the intermediate term trend. Now, I mentioned the construct of volatility derivative. So there's two things that make up the construct. One is whether the VIX futures are trading at a premium or discount to VIX, and the other is the term structure of the futures. So when the futures are trading at a premium to VIX and the term structure slopes upwards, which probably happens 95% of the time, that's bullish for stocks. But when the opposite occurs, it's very bearish, and you need to pay attention to it. That explosion that we had in volatility in February of 2018 was tipped off by the term structure inverting. Now, what I mean by the term structure, well, right now I'm going to show you some specific examples, but here's where the March futures are trading, then the Aprils are here, then May, June, etc. So the term structure currently slopes downwards. Most of the time, they would be aligned like this, sloping upwards, and that would be bullish. But right now, they're in this downward slope, and that's bearish. So here, I took these prices this afternoon, well, right around noon. VIX finished the day at 82 after hitting 83.56 during the day, which I heard somebody say that's a record. It's certainly not an intraday record. I'd have to go back and see if it's a closing record. But during the financial crisis, it did trade up to 90, at least intraday. Anyway, today at noon, VIX was 76.78. The March future was trading at 68.14. So the premium is 68.14 minus the price of VIX, which equals minus 864. So these futures are trading at an 8-point discount to VIX. The next future out a month from now is trading at 54. That's a 22-point discount. The next one out trading at 42, even bigger discount, et cetera, et cetera. They stop growing about there. But you can see how these prices are much lower as you go farther out in time, at least you get that far out. So what does this mean? I've heard some people say, well, the market's saying, don't worry, VIX is going to be lower out there in July. That's not what it means at all. It means that the long-term volatility of the stock market, which is somewhere in the 20s, you have to draw a curve between this point and that other long-term point out there somewhere. And because nobody knows where volatility is going to be in, say, 3 years. And so the term structure has to slope downwards as you go out in time. It's sloping downwards quite steeply right now, but this exact same thing happened in 2008 and would have happened in 1987 if we had it. So it's really nothing new, and it presents some very interesting trading opportunities, which we'll get to in a minute. And by the way, you might want to know where can I get the price of VIX futures? Well, on the CFE, which is the CBOE futures exchange, is where these trade. So if you go to cfe.cboe.com, on their front page, they've got delayed futures prices. So you can see all this stuff. But if you don't want to do that, the CBOE does publish 5 cash-based volatility indices. There's a 9-day index with a symbol conveniently VIX 9D. There's VIX itself, which is a 30-day. There's a 3-month, a 6-month, and a 1 year. And those used to have different symbols, but they changed them to be a little more logical. So this afternoon at noon, the 9-day volatility index was trading at 101. I mean, that's just crazy. VIX was 76.78. The 3-month was here. The 6-month was here. And even the 1 year was here. Now, I mean, 1 year volatility has been below 20 for ages. And now it's above 40. That's just how expensive options are right now. They're just really, really, really expensive. So just to summarize there, the futures are at a discount, the term structure is sloping downwards in the futures, this term structure is sloping downwards in the volatility indices. So this is all bearish, and it's going to stay bearish until it inverts. Now we do have a buy signal that we call the oscillator differential buy signal. I'm going to back up for a second, and I'm just going to erase these. An oscillator differential buy signal occurs when VIX closes below the VIX 3-month. I don't think that's happening anytime soon, but it will eventually, and that will be a buy signal somewhere down the road. Anyways, so I'll summarize this, and then I want to talk about a volatility strategy that we use. The S&P chart's bearish. I mean, there's just no two ways about that. We did have a modified Bollinger Band buy signal that was stopped at, but another one will pop up fairly soon. The put-call ratios are bearish. That's equity only. Total CBOE, they're all bearish. The breadth oscillators are on sell signals, and it would take quite a bit to bail them out. The trend of VIX is bearish, although we have been getting an occasional spike peak buy signal, so we would take those if they popped up. And the term structure we just looked at, that's bearish too. So we basically have everything is bearish except for a couple of very short-term things. So overall, it's bearish. It's just too soon to buy. And if you miss the bottom tick, believe me, you had many opportunities to buy that all the way down, and it wouldn't have done you any good. So don't try to get the bottom tick. We'll wait for these buy signals to come in. They will come in, and they'll probably be pretty good ones, although this market is so destroyed, it's going to have some sort of retest. Anyways, is there a better approach? I mean, even if you get sell signals right now, or if you feel bearish, the cost of the puts is crazy. And so, or if you get a buy signal, the cost of the calls is crazy too. So there's a hedge strategy that we call VIX SPY, and we buy calls on VIX and calls on SPY in a proper ratio, and that, for a number of reasons, works out and has a built-in statistical edge to it. And this is what we've made all of our money on, or not all of it, but most of our money on in the past 3 weeks. And the reason that it works is that the premiums have to disappear by expiration. So this is how things looked at the December 2018 decline. I'm going to show you this one, then we'll talk about the current one also. But you may not even remember this, but right after Thanksgiving in 2018, the market rallied about 200 points, and all the volatility indices were very low priced. So the dark blue line is the VIX 9-day that we just talked about, the cash index VIX 9-day. The pink line is VIX itself. So you can't trade either of those. But all the rest of these things are futures. So there's a weekly future every week. So there was a week for the 52nd week of 2018, the first week of 2019, the second week of 2019. Then the main January future, F in futures terms stands for January, January of 2019, and then February of 2019. So they were all here bunched up together at late November. And let's just say that you still didn't like the way that market looked. There were plenty of people who didn't, and you wanted to buy yourself some protection. So what do you buy? Well, it turns out there's only a couple of things that really worked well. The shortest term thing is always the thing to buy. So we buy 1 or 2 weeks out all the time and just keep rolling them over. Because by the time you got to December 24th, which is right here, the short-term volatility index had traded up to 42. I mean, that's really nothing compared. I just showed you it's 101 now. Actually, I think today it's probably much higher than that. Where is it? 106 it closed out. Anyway, in VIX at that same time, it would close right here at 36. Again, kind of disappointing. But you're really disappointed if you had bought, let's say, January futures as a hedge against your stocks. Here's the January futures right there. If you'd have bought those as a hedge against your stock, they only went to 26. Or even worse, bought calls on those, and the time value premium was decaying. I mean, you didn't hardly get any benefit out of those at all. What did stay close to VIX? Well, it was the front week future right here, the VX52. It came all the way up with VIX around 36. The next week future did all right too. It got up to 32. That's the VX01. And you can see that if it had gone all the way out to February, which doesn't seem that far out, but you didn't hardly benefit at all. So what's causing this? Well, what's causing this is when the market starts to head down and people want protection, they buy the cheapest dollar thing that they can, which is always could be the near-term option. Now they may be paying an outrageous implied volatility for it, but it doesn't make any difference. That's what they want. They'll worry about it later. If the market continues on down, they'll sell that one and buy another one. So the near-term things adhere more to the price of these cash indices than anything else does. So here's today's situation. Again, this was midday, and I showed you a little bit of this on that one chart. But VIX was at 78. Here's the March futures trading at 70.65. That's a discount here. And this one, when I took these prices, it's a discount of $7.85. These futures last trading day is tomorrow. So that discount is going to have to disappear. Well, they actually have an AM settlement on Wednesday morning, and it can be a little bit of a wild cowboy thing. So I don't usually try to get involved with that, but so they might leave them at a couple of point discount going into the settlement, but still $7.85 discount going into tomorrow. So if we could, somehow buy this thing and sell that thing, we could lock in some things. We can't do that exactly though. So, but there are strategies that we can use. But look, just one more week out. Now this again is the next week futures, and remember they have those numbers. So this March 18th is the regular March future, so it has the letter H for March. But the next week out is the 12th week of the year, so it's trading as the VX12 future. And by the way, if you go in and you buy options, VIX options, and you buy those March 25th options, the underlying contract for those is the VX12 futures, not VIX. VIX is not the underlying contract for any of the VIX options until expiration, when they all have to price up to VIX on the settlement. The next week out is called the VX13. That's one's expiring on April 1st. The next week out, VX14. And then finally, the futures in April are VXJ, back to the regular one. Those are trading at 56.70. And I believe these are closing prices today, or they were late in the day prices. Let me just look right here. They closed at 58.85 with VIX at 82. So anyway, that's a 22-point discount. So I'm just crazy. That discount has to disappear. Either the market will collapse and those VIX futures will go up to meet VIX, or the market will rally and VIX will come down to meet the futures. But in one way or the other, in some market movement format, that 22-point discount has to go away by April 15th is when those futures expire, and the same for the other ones. Now these weekly futures are pretty illiquid. You can buy options, and they're not so liquid either. But so it kind of forces you into this one if you really want to trade size. Fortunately, this one has been the size trader was this week, so it's been good for us. So we've had a number of trades based on this strategy. It's not a real complex strategy, but essentially what we're doing is we're buying calls on VIX. Since we can't short VIX, the next best thing we can do is buy the stock market, which should go up if VIX goes down. So that's why we call it a VIX SPY strategy. And we're going to have a webinar on that strategy alone this Thursday. If you're interested, we're charging for that one just because, our subscribers have made literally thousands on this. We're charging $69 for it just to say we didn't give it away for free. So if you're interested in learning how the strategy works in depth, that's what we're going to be talking about on Thursday. Otherwise, as I said, if you go to optionstrategist.com, that should say MAR30. MAR30 here, MAR20. That gets you to the point where you can get a 30% discount on daily volume alerts. Daily volume alerts not only trades all these systems, but we also look for takeovers. So before. Right now, there's no takeovers happening, but we did hit a few last fall and this spring or this winter. Also, the Daily Strategist, which comes out twice a day and includes the Option Strategist as part of that subscription, is also being offered for 30% off at optionstrategist.com/MAR20. Just a couple of other things. We do have a series of Saturday webinars once a month. We discuss the market, we answer questions, and then we talk about a topic. This topic this week is just option basics, so it's a beginner seminar, but you might be interested in that. And that's if you sign up for that and pay the full price, you have access to all 14 webinars that we do. We also have a YouTube channel that we record on every Monday morning. And again, there's the discount for these newsletters that are coming up right now. There's my email address. There's the discount. And if you're interested in our money management, our minimum account size is $100,000. We have basically it's all the same strategy, but we have a couple of different variations of it for IRA accounts, for futures accounts, etc. So let me see if we have questions. I can undock this. Oh yes, looks like we do. Okay. Oh yeah. No sound. No sound. No sound. Hopefully, got that fixed up. Okay. I'm running down my trying to find an actual question. Okay, here we go. So okay, there we got it working. The number of questions backs off after that. All right, so somebody asked about Boeing. We had some good sell signals on Boeing last fall, put call ratios signals, and they were quite accurate. So there's no reason for me to suspect that the next buy signal in Boeing wouldn't be tipped off by the put call ratio too. But right now, put call ratio in Boeing, it looks just like any of those other ones, just racing to the upside as the stock is collapsing. The weighted put call ratio is up to about 250, which is a very high number for Boeing, meaning the $250 that puts are being spent on puts for every $100 being spent on calls, but it won't be a buy until it rolls over. So that's going to take some time. Okay, so someone asked, does $3 seem like the right number for spike peak buys at these levels in VIX? Good question, because we tested this in 2008, and it turned out that it worked okay in 2008. I mean, we had, in a bull market, that indicator hits like 90% of its signals. In a bearish market, it's less accurate than that. But it did turn out that 3 was still good. So that's why we've kept it there. I could go back and take another look, I suppose, but we're swinging faster now than we did then. But still, we did have a lot of pretty big swings. Discuss the divergence between the AD line again. Only works for negative divergence. Okay, so what I'm talking about is cumulative advanced decline line. So if you just every day you add up the advances minus declines, you keep adding it to the number. We keep that for two different indicators, the stocks only and the New York Stock Exchange. And where you get your negative divergence is, let's say they're both going up in January of this year. They both went up to new all-time highs, both the stocks only cumulative advanced decline line and the New York Stock Exchange cumulative advanced decline line and the S&P 500 index and the Dow. Everything was at new highs. But then S&P went on to new highs, and the stocks only cumulative advanced decline line did not. There was enough negative breadth days that it started to back off. And so after January 16th, it didn't make another new high, even though SPX continued to make new highs all the way into, February 20th or whatever. So that was the negative divergence that we're looking for. So will you provide the slides for download? Yes, tomorrow you will all get a link to the slides and the recording of this webinar. Oops, jump past one. Do you use other indices like VXO, VVIX, etc.? We pay attention to them sometimes, but right now I'm not. At the VXO, we have some strategies that we use when it gets too low. I don't really have anything different than at new highs, although I believe it did make a new all-time high recently too. What are the strategies that are effective in such a high cost of options and implied volatility? Well, so one that is what we call put ratio spreads, but it involves selling naked options, and that can be quite hairy, naked put options at this point in time. So we have that strategy, we use it. It took one big hit in late February, but we were hedged with some long VIX calls against it. And now we put on a position just the other day in our newsletter. So if you get a copy of the option strategies newsletter, you can look at it. I would not go too big on that, but it is because the out of the money puts just get ridiculously expensive. You can, what we do is we buy a put bear spread at current levels, current strikes, and then we sell a deeply out of the money put, and that bear spread hedges that put for a while. But if the market goes below the strike of that put, then you've got a tiger by the tail. So it's not something for everyone, but it is a strategy that works in these high environments. So today, S&P 500 futures that expire on Friday were 25% over the expire on March 31st. You think a double calendar is a good trade? I'm not sure. You're talking about calendar spread and options. I mean, we have a strategy that we use in the option strategist, which does involve double calendar spreads and spider options. I typically go out a little farther than that, though. I think right now we just bought April and sold March 20th using strikes that I believe are 20 points out of the money on each side. Hold on, let me just look that up. I got it right here. But it's a strategy that's worked pretty well. As I said in the newsletter, we have those ones where we have the track record of them. So over the years, it's made money. It's made a little money here recently. It lost some this week too. Yeah, so we did a calendar spread, call calendar spread 20 points above SPY, another one 20 points below SPY. And, if you get in the money, you have to roll it. But if you're interested in that strategy, we do follow a strategy like that in the option strategist every week. Is the track record of the managed accounts available? Yes, it is. We have tear sheets on all of our situations. If you would just either fill out a request at McMillanAsset.com or give us a call or even shoot us something off the regular website, someone will contact you. Do you advise trading all the strategies at the same time or just concentrate on one? I mean, we typically trade them all. As I said, we have a core bearish position. We've had a few losing call trades against it, but the VIX trades, we keep them first and foremost. And as long as these discounts persist in these VIX futures, we are going to be trading those things pretty heavily. With the VIX hedge SPY strategy, initially I was submitting a delta neutral position. Technically, yes, and I'll explain that in the Thursday webinar. 25% above volatility above. Okay, I'm not sure what that meant. Is there a ceiling for VIX? I see people buying the 100 strike. Yeah, there's no real ceiling. I mean, as I said, in theory, it got to 150 in the crash of '87. It's based, on the price of SPX puts. So if people panic and want to buy the puts, I mean, it was going up all afternoon today and closed right near its high. So people are still buying those puts as protection. And, VIX is just a 30-day window. So I mean, you can imagine how expensive those things are. CC eats an initial delta neutral position. Typo. Create a delta neutral position initially. Yeah, well, that's the one in the volatility. Yes, we are creating a delta neutral position. So essentially, it's like owning straddles on the market, sort of. How do you decide on the ratio that VIX buy trades? Well, it has to do with the units of trading and volatility and price. Again, I'll give that formula in Thursday's webinar. Okay. How option put call interest affects price actions. It's long. Is this a question? Hey, I don't know. There's a long comment there. I'm not sure what that was. So that one, Arun, if you want to just send me short squeeze effect on options. I would have to read that one over. It's a long question. So let me take a look at it. I'll try to just shoot me an email and I'll try to answer it. You mentioned something about vertical spreads, questionable, somewhat contrary when talking media heads touting them. So what I'm saying is most of the time you don't want to use a vertical spread. Let's say you have an opinion on a stock. Let's say a month ago before things were crazy, you wanted to be bearish on JP Morgan. So you buy a put. But on TV, they always buy a put spread. And so that sale of that other option cuts off your profit potential. And they do it all the time. It's not necessary to do it all the time. If options are fairly priced or low priced, you don't need to do that. And somebody will say like, well, yeah, but it doesn't cost as much. Well, you're risking 100% in either case. So if you're going to buy an option for 4 or buy a spread for 3, then only buy 3/4 as many options and keep your profit potential unlimited. That's all I was talking about. I don't know why they do that on TV all the time. If somebody thinks it's a legal issue or what, but seriously, professional traders use vertical spreads somewhat judiciously, not all the time like that. What email to send to me? It's right here on this page, lmcmillan at optionstrategist.com. And when will the Fed start buying stocks? Well, that's an interesting question. So, and if you remember, I was trading the crash of '87, so that happened all pretty quickly. This is taking much longer. But the day of the crash, the market was in total disarray. Then the night they flooded liquidity from the Fed, and the market gapped up and opened up like 200 points higher, which was we were at the time trading around 1700. So that's a pretty big move. By I'd say 10:30 a.m., 11 a.m., we had given it all back. The market went negative. The market makers started closing, or the specialists started closing posts because of the order imbalances, and it was just like this eerie silence fell over everything. And then they closed the exchange. It's called a trading halt. They didn't have circuit breakers then. They just called a halt because there were no buyers. And when it came out of the halt, about 20 or 30 minutes later, there was a minor index called the XMI index. It was actually the Dow, but it traded on the American exchange. The American exchange didn't have rights to call anything the Dow product, so they invented this thing, XMI, and it was composed of mostly the same stocks as in the Dow. Anyway, it had futures and options, and out of nowhere, after this trading halt, a huge buy order comes in from Goldman Sachs to buy the XMI. And of course, being illiquid, it just ripped higher. But all the market makers and everybody who was short that had to turn around and buy Dow stocks to hedge themselves. All of a sudden, the Dow takes off. And it's always been speculated that that was a government buy order. And I probably was. I mean, I don't think there's anything wrong with the government trying to halt the decline. We're not some sort of like Austrian uh, economic situation where we have to let things play out to their dire end. So would the Fed buy now? I don't know. If they have so far, they haven't been very effective. But it's always a possibility. I believe it has happened before. So your thoughts about selling credit spreads instead of debit spreads? Well, again, I mean, if you're spreading, I'd probably rather prefer the credit spread, but a lot of times the spread doesn't make sense. How do we sign up for this Thursday session? If you go to that same page, MAR 20, the sign up is on there. Right, Karen? Yeah, it's there. When you advise obtaining an option, it closes some certain point. Actually, time you consider market close 4 p.m. or 4:15. Well, so what in our recommendations, a lot of times we'll say if the stock closes here, then do that. So if it's SPY or something that trades until 4:15, then you see where it closes at 4, and you have a chance to do it to 4:15. If not, you have to kind of be paying attention to, going into the close 5 or 10 minutes. Oh, or you could just see the next morning if it closed there and then get out the next morning. I mean, yes, it's not exactly the same, but over time, you'll do better on some and worse on some. We probably should just average it out. So that's how we usually have people handle that. When will government buy stocks? Question. Trump said they will backstop the airlines in presser today. I think that meant financially. I don't think that meant stocks. But again, I'm not a question on that stuff. I'm not an expert on that stuff. So I don't think they would come in and waste their money buying individual stocks. That probably could get hairy then. But if they just buy some broad market index ETF, I think they could probably do it. I mean, remember for years there was talk about a plunge protection team. Anyway, here somebody mentions it right here. Yes, that is the plunge protection team. Again, always unclear whether it really existed or not. Why is the Fed's action for the rate cut repo having no or negative effect on the markets? Well, it seems to me that people are much more worried about the contra virus and shutting down businesses. I mean, if your business is going out of business, what difference does it make if you can borrow at zero interest? If you have a barber shop or a restaurant or something like that, and the government has said close all these things, then what what does zero interest mean? So I think that's part of the problem. We're just going to have to work through this panic and find a bottom in here somewhere. One of my better traders thinks that we won't really bottom out until the FANG stocks become the worst performers. Right now, they've sort of been better performers than the SPX. So I don't know. I'm not too sanguine about us finding a bottom right away, but we will have our indicators at work. All right. I think I'm going to end it here. Here it says, in your newsletter, it looks like you recommend individual stocks that have low liquidity. I'm not sure what you mean by that, but shoot me an email and we'll talk about it. Because typically, that's not true, but it might be a couple. So thanks for attending. As I said, you'll get the PDF of this, and you'll get the recording, link to the recording. And I hope you can join us on Thursday and even perhaps on Saturday as well. And thanks for listening.